TSP loan basics. That's what we're going to talk about here today, directly from TSP.gov/plan participant/loans and withdrawals. Had a good question from a guy who thought TSP loan was a different way than a typical 401k loan. And I said I wasn't so sure about that. And so he sent me this link about TSP loan basics. I said, man, this would be a great video to do. Let's dive right into it because, TSP is huge. I mean, my goodness, anyone in the federal government and military who doesn't have TSP, I wonder what you're doing. The TSP is a wonderful, wonderful retirement plan scenario, and it has a loan provision, and we need to understand how this works. So don't forget to subscribe down below. As always, thumbs up, comments, the whole thing. So let's dive right into this. Again, directly from the TF Thrift Savings Plan, TSP.gov, and I'll put a link in the show notes. So this guy, he had email or put a quote, a comment on my YouTube channel about he thought that when you took a loan out from the TSP, the amount of money you borrowed to put back in automatically went in the G fund as opposed to going into the I fund or the F or the C fund or the S fund. And I said, I don't know that to be true. I don't know it not to be true. That seems odd to me. But he said I had to do some digging, and then he sent me this link right here. He goes, I'm still not sure. So let's find out. Let's see if that's true, because my whole premise on my book right here, Strategic Money Planning, why you should borrow from your 401k, is that you can borrow from your 401k and you're dollar cost averaging the amount that you borrowed back into the market because you have to pay your loan balance back. You're not paying the bank, you're paying yourself essentially at 5% interest, whatever the interest is at that time you take the loan. But that money you're putting back in is also getting growth-like returns too, because it's going back to the market on a monthly or bi-monthly. Was that bi-monthly? Yeah, twice a month, paycheck time. So anyway, his set premises, I don't think that's true. I think he wasn't challenged me, just said I think on the TSP, it all goes back to the C fund, or not C fund, the G fund. I said, I don't know. So anyway, all right, the TSP loan allows you to borrow from your account while you're employed by the federal government or while you're a member of the military. Before taking out a loan, you should understand things. Okay, so good. When you take out a TSP loan, you borrow from your TSP account. The amount of your TSP loan cannot exceed the amount of your contributions and earnings from those contributions. So if you work under the federal FERS, Federal Employment Retirement System, not SRS, just FERS, you cannot borrow from any agency contributions or earnings from those contributions. So if you work under FERS, you cannot borrow from any agency contributions or earnings from those contributions. All right, so they're saying the amount of your TSP loan cannot exceed the amount of your own contributions. Okay, gotcha. So you can't borrow against your vested amount. It can only be against your amount that you put in there. Well, that's different. I know that for a fact. I don't know that for a fact. That's different than my understanding of 401k loans. You can borrow against your vested amount. In fact, I'm quite certain that's the case. But in this case, they're saying you can't. You can only borrow against the money you put in and your contributions that are made off the money you put in. All right. So if you meet eligibility rules and your loan request is approved, the loan amount is removed from your TSP account. You must repay your loan with interest. Repayments for the loan and interest are generally made through payroll deductions. Your repayments restore the amount of your loan plus interest to your account. All right. Loan types. The TSP loan allows you two types of loans. General purpose may be used for any purchase. Purpose requires no documentation, has a repayment term of 1 to 5 years. That's the only thing I don't care about this buying a home thing. I don't. So if you want to do it to buy a home, look at that. I'm not a fan of that, but I am a fan of borrowing against your TSP and your 401k to pay high credit card debt for sure. Eligibility rules. If you have both a civilian account and a military account, the loan eligibility rules apply to the TSP account from which you intend to borrow. To be eligible, you must be employed by the federal government or the military, must be in a pay status because repayments are set up as payroll deductions, can only have one outstanding general purpose loan and one outstanding residential loan from any TSP account at a time. All right, that's different than a 401k. I had 2 loans against my 401k, and they said you can't do that. You can only have one outstanding general purpose loan at a time. That's it. Must have at least 1,000 of your own contributions and earnings in your TSP account. Agent contributions and earnings cannot be borrowed. Again, good to know. I did not know that. Must have repaid a TSP loan of the same type in full within the past 60 days. So you can't take one out within 60 days of paying off the other, if that makes sense. Must not have had a taxable distribution of a loan within the past 12 months unless it was a result of separation of service. Must not have a court order against your TSP. And again, I'm not talking about residential loans. Just I'm not a big fan of them. The minimum loan amount is $1,000. We talked about it must come from your own contributions. The maximum loan amount, now this is going to be basically on IRS standards. Your own contributions and earnings on those contributions in the TSP account from which you intend to borrow, not including any outstanding loan balance. 50% of your vested account balance, including any loan balance, or $10,000, whichever is greater, minus any outstanding loan balance. 50,000 minus your highest outstanding loan balance, if any, during the past 12 months. Even if the loan is currently paid in full, wow, it will be considered in the calculation if it's open at any time in the last 12 months. That's interesting. So if you borrowed $25,000 8 months ago and you paid it back, and now we're in month 10, you don't have any loan balance outstanding, you can still only borrow $25,000. You got to wait for it to be within the last year before you can borrow the full thing. So again, that's different than 401k. TSP loan balances are recalculated at the end of each business day, okay, based on daily share prices. As a result, the maximum loan amount may change on a daily basis. Here's the direct cost. The TSP charges a loan fee of $50 for admin purposes, which they deduct from your loan proceeds. The interest rate on your TSP loan is the G fund. Yeah, exactly. I'm telling you, that's what it is. The interest rate is the G fund at the time your loan application is processed. The rate is fixed for the life of the loan. All the TSP loan interest is non-tax deductible. All your interest goes back into your TSP account. I cannot stress that enough. So you're paying the interest. In this case, they're using the G fund, which is pretty commonplace. When I borrowed from USAA, they're paying is like prime. I can't remember what it was, but essentially the G fund. That makes sense. So the interest that you're paying back is the G fund. Although you pay the loan back to your TSP account with interest, the amount of interest you pay may be less than what you might have earned if the money had remained in your TSP account. Yeah, exactly. Indirect costs include sacrifice earnings. That's just opportunity costs. So 100% right. So basically, I don't see how this guy was saying that it's going back into the G fund. That I don't know that to be true. In fact, let's see if we got repaying your loan. I think it just takes us down here. Payroll deduct loan interest, extra payments. All right, so let's just go here. When the TSP pays out your loan, it will notify your payroll office immediately. Okay, check your LES, leave an earnings statements. When you repay your loan, you pay it with interest. The repayment amount gets deposited back into your TSP account and is invested in accordance with your most recent contribution allocation. So there's the answer. Your repayment amount gets deposited back into your TSP account and is invested according to your most recent contribution allocation. So I can't stress that enough. That's simply saying if I have the Life Cycle 2050 fund and I'm repaying the loan back, it is going to the Life Cycle 2050 fund. The interest that I'm being charged to myself again is the G fund. All right, so just keep that in mind. There's two ways you're getting money back: is the interest, which in this case is the G fund, and then I'm paying it whatever I'm getting on the Life Cycle 2050 fund or the I fund or the F fund, whatever you're doing. That is the account growth potential or loss. I'll tell you. I mean, that's the opportunity cost. Is that if you borrowed $50,000 from your TSP and you're just paying it back at your interest, you're paying back as G fund, and then the market goes up 35%. Well, you're only getting the interest back at G fund. Now, the money you're putting back in on a monthly or bi-monthly basis is going into the Life Cycle 2050 fund. That could still be going in and gathering that booming stock market, but the bulk of it is missing out on that for sure because you don't have it in there. That's the opportunity cost of borrowing against your 401k, or in this case, a TSP. Counter to that, if you took $50,000 out and you're paying yourself back at interest according to the G fund, say 3%, and the market falls 40%, well, that $50,000 is excluded from that market decline because you don't have the money in there. So it's an opportunity cost, but it also is an opportunity to miss down markets as well. So you can make extra loan payments in addition to your payroll deduction at any time using a personal check, cashier's check, or money order. Missed payment, you can't make up missed payments. You just don't want missed payments for sure. The TSP will report your loan transaction on your quarterly participant summary. Review this information carefully to be sure to report any discrepancies to your agency. Okay, so a couple things on this I just want to clear up. So no, you're not paying the interest back. you still are investing it basically how your allocation is for contribution. So the TSP was very explicit in that regard. 2, your interest is based on the G fund rates. That's typical. Absolutely. Again, the interest that I had at USA was based on prime or something like that. It's a similar scenario. So that makes sense. The one thing that's interesting about the TSP is that you can't borrow against the government contributions and earnings. You can only borrow against your own. So that makes it going to be harder, frankly, to get a bigger balance in there for which you can borrow against them, because at USAA, I mean, they're paid. It was a wonderful 401k plan with a profit sharing. And so you put in, $10,000 and next year's worth 25,000. If that puppy was fully vested, I could borrow 12,500 because you can borrow 50% of your vested balance or 50,000, whichever is less, even though I had only put in 10,000. In the TSP scenario, I can only borrow 10,000 in that case because that's the max you can borrow, your contributions and or earnings. So hope this helps. As always, don't forget to subscribe down below. Again, if you find value in this and you want to donate to the cause here, go to heritagewealthplanning.com. There's a little donate button. Feel free to do that. 5, 10 million bucks, whatever you want to do. Comments, thumbs up, and don't forget to subscribe, and we'll see you next time. Thanks, guys.